On May 19, 2026, the Philippine Peso closed at 61.75 to the US dollar. For traders, it was a number on a screen. For the central bank, it was a warning. But for ordinary Filipinos, it meant something much simpler. Every dollar the country needed had just become more expensive. Fuel, food imports, medicine, machinery, foreign debt payments, all of them became heavier in peso terms. Because the Philippines depends heavily on imported goods and foreign currency flows, the peso's fall did not stay inside financial markets. It moved into ports, into the trucks, into the wet markets, and into the family budget. This is the real story behind the peso crashing to 61. It was not just one bad trading day. Oil prices, inflation, global dollar pressure, trade deficits, and market fear were the sparks. But the fuel had been building for decades. The Philippines built an economy that needs dollars every day, but still does not earn enough from high-value production at home to remove that pressure. That is the trap. The immediate pressure was clear. By April 2026, headline inflation had jumped to 7.2%, up from 4.1% in March. Transport inflation surged to 21.4%. That matters because transport is the bloodstream of an island economy. When fuel rises, trucks cost more to run. When trucks cost more, food costs more to move. When food costs more to move, market prices rise. And when market prices rise, wages feel smaller. At the same time, the country was buying more from the world than it was selling. In March 2026, the Philippines posted a goods trade deficit of $4.51 billion. Imports made up 60.8% of total external trade. Exports made up 39.2%. So when the peso fell to 61.75, it exposed one brutal fact. The country needed dollars constantly, but dollars had become more expensive. That is why the peso crash was not just a currency story, it was a production story. The short-term causes were clear: oil pressure, inflation, trade deficits, global dollar demand, and market fear. But the reason those pressures hurt so much is deeper. The country does not produce enough of what it needs. So when the peso weakens, it cannot easily replace expensive imports with cheaper local products. It has to keep buying from the world, and much of world trade is priced in dollars. To see how personal this becomes, go back to late 2022. In Metro Manila, onions became more expensive than a full day of minimum wage labor. In December 2022, onion prices in Metro Manila ranged from about 600 to 700 pesos per kilo. At that time, the NCR non-agricultural minimum wage was 570 pesos per day. So 1 kilo of onions could cost more than a full day of work for a minimum wage worker. Onions became expensive because of supply problems, shortages, smuggling, hoarding concerns, and weak planning. But the deeper lesson was simple. If a country cannot produce and manage enough of what it needs, every supply shock becomes a household shock, and every currency fall becomes a household problem. That is why 61.75 matters. It is not only an exchange rate, it is the price of dependence. Imported fuel, fertilizer, machinery, and foreign currency debt all become heavier in peso terms. Import-dependent businesses either absorb the loss or pass it to the consumers. The Philippines needed more dollars to pay for imports, but the peso was losing value against the dollar. That is the squeeze. One symbol of this problem sits about 100 kilometers west of Manila. In Bataan, there is a huge concrete structure that still stands today, the Bataan nuclear plant. It was built during the Marcos era after the 1973 oil crisis, when the Philippines wanted to reduce its dependence on imported fuel. On paper, the idea made sense. A nuclear plant could produce electricity at home and help protect the Philippines from another global energy shock. But that is not what happened. The plant was completed in 1984. It was never loaded with nuclear fuel. It was never commissioned, and it never supplied electricity to Filipino homes. Bataan matters because it shows a pattern. Borrow in foreign currency, build a huge project, fail to get the expected return, then spend decades paying the debt. A project can fail in 1 decade, but the debt can survive into the next generation. Filipinos finished paying the loans and interest for the plant in 2007. The total paid was 64.7 billion pesos. 43.5 billion pesos went to principal, 21.2 billion pesos went to interest, and yet the plant never generated electricity for the grid. The Supreme Court later affirmed that Herminio Dicini, a close associate with Ferdinand Marcos Sr., had received ill-gotten commissions connected to the Bataan project. Debt is not always bad. A country can borrow to build roads, ports, power plants, and railways. But if those projects do not produce enough value, the debt does not disappear. It collects interest. It eats public money, and if the debt is tied to foreign currency, the country becomes more exposed whenever the peso falls. The peso story is also a debt story. When the currency weakens, foreign currency debt becomes harder to carry. The government needs more pesos to buy the same number of dollars. And that money can leave less for hospitals, for schools, roads, and support programs. So a weak currency can become a budget problem, then a household problem. By the early 1980s, the Philippines was already under heavy pressure. The country had borrowed heavily. U.S. interest rates were rising. Export earnings were under pressure, and the government needed more dollars to keep paying its debts. Then came 1983. Opposition leader Benigno Aquino Jr. returned to the Philippines from exile. He was assassinated at the airport on August 21, 1983. As confidence collapsed, pressure on the peso increased. The Philippines faced falling reserves, rising debt pressure, and a loss of trust in its financial management. This is how a currency crisis begins. It starts when banks and lenders doubt that a country can defend its currency and pay its debts. Once trust breaks, every choice hurts. Spend reserves, and dollars run down. Raise interest rates, and loans get expensive. Borrow more, and the debt grows. Let the currency fall, and imports become more costly. In an import-dependent economy, that cuts deep. After the debt crisis, the Philippines accepted reforms pushed by international lenders. It reduced trade barriers, it removed import controls, it lowered tariffs. The goal was to make the economy more open and competitive. At first, that sounds logical. Opening an economy can bring cheaper goods and foreign investment. But the Philippines opened up before enough local industries were strong enough to compete. Domestic manufacturing did not become strong enough. Agriculture remained vulnerable, and the country became more dependent on imported fuel, machinery, fertilizer, food products, and industrial inputs. This created the peso trap. When the peso is strong, imports feel affordable. But when the peso weakens, import costs rise quickly. Because the country lacks enough local substitutes, consumers cannot easily switch to cheaper local goods. In theory, a weak currency should help exports, but the Philippines does not fully fit that textbook story. Many Philippine exporters also depend on imports. Take electronics. Electronics are one of the country's biggest export sectors, but much of the Philippine semiconductor role is still in assembly, testing, and packaging, not front-end wafer fabrication. The Philippines exports electronics, but it also imports many of the materials, components, and machines needed to make them. So when the peso falls, exporters may earn more pesos from dollar sales, but they may also pay more pesos for imported inputs. The advantage is limited. In December 2024, Philippine electronics exports were almost flat month-on-month, while semiconductor components and devices fell sharply year-on-year. So the weak peso did not automatically create an export boom. It mostly made imported costs harder to carry. And if exports do not grow fast enough, the country has to find dollars somewhere else. This is where the Philippine model becomes uncomfortable. The country found two ways to earn dollars without high-value factories. First, it sent workers abroad. Then, it sold office labor to foreign companies at home. The first dollar machine is remittances. Millions of Filipinos work abroad and send money back home. In 2024, personal remittances from overseas Filipinos reached $38.34 billion. That was about 8.3% of GDP. This money supports families. It pays for food, tuition, rent, medicine, homes, and small businesses. At the national level, it also brings foreign currency into the country. Those flows support consumption and help families survive shocks. But this also creates a painful reality. The Philippines has learned to stabilize part of its economy through workers who leave. Instead of earning enough dollars from high-value industries at home, the country earns a huge amount from its people abroad. Remittances help the Philippines survive, but survival is not the same as strength. A strong economy should not need so many families separated just to keep foreign currency flowing in. The second dollar machine is the BPO industry. In 2024, the Philippine IT BPM sector reached about $38 billion in revenue and 1.82 million jobs. Its roadmap aims for $59 billion in annual revenue by 2028. This sector earns foreign currency without exporting physical goods. A Filipino call center, finance support, or IT support worker can serve a foreign company and bring dollars into the country. But BPO reveals the same problem in a different form. The country is still not exporting enough high-value products. It is exporting time, English skills, night shifts, customer service, and back-office work. That work is real. It supports millions of families. But the model depends partly on a wage gap. Foreign companies come because Filipino workers are skilled, English-speaking, and cheaper than workers in rich countries. When inflation rises, that model becomes harder to defend. Workers need higher wages because food, rent, transport, and electricity are rising. Companies want to keep costs low because that is why they came. In April 2026, a BPO workers group filed a petition seeking a 1,200 peso daily minimum wage in Metro Manila. At that time, the NCR non-agricultural minimum wage was 695 pesos. A weak currency may help companies that earn dollars, but it hurts workers who spend in pesos. The company sees the Philippines as affordable. The worker sees the grocery bill rising. That is the contradiction. The Philippine economy has become very good at earning dollars through people, but it has been weaker at earning dollars through strong domestic production. That is why the peso crash matters. It happened in an economy depending on imports, foreign currency debt, overseas workers, and outsourced labor. This brings us back to the 61.75. The trade deficit showed that imports were still larger than exports. Inflation showed that imported costs were reaching households. Transport prices showed how oil shocks move through the economy, and the peso showed how expensive the dollar had become. A war can push up oil prices, a stronger US dollar can pull capital away, higher interest rates can make foreign currency debt more expensive, a bad harvest can force food imports, weak exports can leave the country short of dollars. All of these pressures meet in one place: the exchange rate. This is why the peso problem is not just about the central bank. The central bank can raise rates, sell dollars, and defend the currency for a while. But it cannot magically create factories. It cannot instantly make agriculture strong. It cannot remove oil dependence overnight. A currency is only as strong as the economy behind it. The peso did not crash to 61 because Filipinos are not working hard enough. The problem is not labor. The problem is structure.